Alright, what's up everyone? In today's video we're going to be talking about some news that just came out, and this news is pretty important. It's regarding the Federal Reserve and some banking regulations. So this is definitely something that I've been keeping an eye on closely over the last year, and something that seems like is setting up to actually be pretty relevant here in the near future. So I thought we'd cover that really quick and see what's going on. So the news is regarding this guy right here. His name's Michael Barr, and you can see the title. This is a Reuters article. You can see the title is Barr Sworn In as Fed's Top Wall Street Cop, the Newest Rate Setter. So if we scroll down, you can see Michael Barr is sworn in as Federal Reserve Vice Chair for Supervision. And Michael Barr sworn in on Tuesday as the Federal Reserve's new Vice Chair of Supervision. Barr will take the lead on the Fed's regulatory agenda. The former senior Treasury official is potentially tightening up rules on banks to make them more resilient to financial stresses or climate change. So that does a pretty good job of just explaining what's happening, at least what just happened this week. It doesn't really tell you any significance on why this is important, and we can go over that here very shortly. But just for the meantime, before we move on, I do want to point out really quick, I think it's interesting that we have more of this swapping between Treasury and Federal Reserve. You had Janet Yellen move over from the Fed to the Treasury. Now you have senior Treasury officials moving over to the Fed. So I don't think this is like individually significant, but just as the trend that we've seen over the last year or two, I think it's going to make it easier for them to parlay regarding combining the monetary and fiscal policies moving forward. So just something I find interesting. Just wanted to point it out before we move on. So with that, let's come over here. And who is Michael Barr, and why is his perspective important to the economy? So Michael Barr will likely revisit policy on the supplementary leverage ratio, the SLR, an element governing banks' capital requirements. The Fed temporarily eased its SLR rules at the start of the COVID-19 pandemic, such that treasuries and deposits won't count among banks' assets. So this was pretty important, as the primary dealers that are conducting QE would be able to just stack up a whole bunch of reserves, and it wouldn't really influence their ability to participate in just markets in general for the most part. But now the treasuries and deposits do count against the bank's assets. They count against the leverage exposure. So basically it got to the point where after the exemptions expired and they were not renewed, that all the primary dealers and depository institutions had too many reserves on their balance sheet, and it shot up their total leverage exposure to the point where it was all over the news that a lot of major primary dealer banks were at risk of having to turn away consumer deposits, which was a pretty bunk deal at the time. So that's something that was pretty impactful over the last year. And we're not going to do too deep of a dive on it, as we've already covered this in other videos. So I will post those so that you guys can go check them out. I think it is extremely important and extremely valuable knowledge to have in this current environment we find ourselves in. So I highly encourage you to go check those out if you haven't seen them yet. But this is more of an update regarding that circumstance. So yeah, I guess let's move on to this next part. And as I said, I did a pretty deep dive on this, so we're just going to go over the basics right now. So the supplementary leverage ratio takes into account Tier 1 capital and divides that by the total leverage exposure. So Tier 1 capital, as defined in Basal III, is consisting of common equity Tier 1 and additional Tier 1 capital, subject to adjustments, deductions, and transitional arrangements. And then the total leverage exposure takes into account both on-balance sheet assets as well as off-balance sheet exposures, such as derivatives, repo-style transactions, and other off-balance sheet items. So this is where both reserves, the consumer deposits, and treasuries were exempt from. So they did not count towards the leverage exposure from March of 2020 to the end of March of 2021. So this was, in my opinion, a very big contributor to the huge bull market that we had coming out of the pandemic, as it really allowed the Federal Reserve to go in and monetize the debt and all the fiscal spending that was going on. So now that the exemptions are expired, it's a lot harder to get away with that kind of stuff. So we did a deep dive. Go check it out if you're interested. I find it very interesting. But let's move on to see a little bit more about how this is exactly influencing the economy, just so you guys are up to date. And then we can move on and see what we think is going to happen here in the near future. So this is a really good article, I guess, from the bearstrap.report.com. And let's get into it really quick. In the post-financial crisis era, capital adequacy has been an important driver of the strength of U.S. banks relative to the rest of the world. The supplementary leverage ratio, SLR, is the ultimate measure of capital adequacy. If the Fed doesn't extend the SLR, it will have a large impact on the bond market, which would bring high stress. So essentially, the SLR measures in percentage terms a bank's ability to take losses on its assets. And keep in mind, this article is from March 11th of 2021. So this was right before the exemptions expired, so this isn't anything new. But at the same time, it's something that's very important, and it's only been around since 2018. So in the grand scheme of things, it's still pretty new, but this article isn't quite as timely. So this is just an overview of how it affects markets, and I think it does a pretty good job of explaining it shortly. So let's finish this article really quick. If the Fed ends the SLR cushion, we see U.S. banks as a net seller of treasuries, and that's something we were talking a lot about several months ago. So we definitely thought that without the ability for primary dealers to really absorb as much of the treasury market as they had been in previous year, that would lead to them having to unload a lot of treasuries off their balance sheet, which was going to cause a supply-demand mismatch in the treasuries market. And sure enough, that is exactly what's happened. And we're at the point where yield curves are inverted all across the range, so range of durations. So we're definitely at the point that we were talking about, we thought we would get to in our last videos regarding this. So it's something very interesting to me and something I find valuable to be paying attention to, as I mentioned before. So let's finish up this article really quick. With the Treasury General Account cash coming in by this summer to the tune of $1.1 trillion, as per the current TBAC schedule, bank SLR defined as Tier 1 capital divided by the total leverage exposure, which here they get a little bit more specific, on and off balance sheet assets, will decline. This is because deposits will come in and cash will go up at banks. Cash assets is in the denominator of the SLR calculations. As a result, U.S. banks won't have room to accommodate the cash deposits. Their SLR could trip minimum requirements. So this is also something that we were talking about being a problem. We also explained that this is a big factor in what's going on in reverse repos. So if you guys are still paying attention to the reverse repo market, I know that was a really big deal last year. So it's still just as high as it was back then, over $2 trillion. And a lot of this or a lot of that was actually overflow from money market accounts going into the reverse repo because their tier 1 or their total leverage exposure was too high. So that's something that we also talked about in another video, and I will link that one also. And then the Fed could fix all of this by excluding cash and treasuries from the SLR calc, making the denominator lower and the SLR higher for banks so they don't trip their minimum requirement, which is 6%. So we've been talking about, this is our thesis as to what's going to be happening here in the near future. We believe that at some point they're going to have to adjust the supplementary leverage ratio to permanently exclude reserves and treasuries from the total leverage exposure. So that's pretty much our thesis, and this news that we got definitely plays into that. So let's look at this last little paragraph and then we can move on. So no supplementary leverage ratio relief means that banks must turn away deposits, and then there is nowhere for money market capital to reinvest. Example, reverse repos, which is still capped. That money market fund bill maturities floods more cash. So basically what we were just saying, the reverse repo inflow limit was, I believe, $200 billion per entity several months ago. I believe it actually did get raised. So the cap actually did get raised, I believe. So that was something that they tried and still not working. So I think that leaves the idea that the supplementary leverage ratio needs to be adjusted. So entire money market Constellation trades close to zero or lower, and banks can't buy treasuries, no room on balance sheets due to SLR, so they start puking them out. Trouble. And sure enough, that's exactly where we find ourselves today. A huge supply and demand mismatch in the treasuries market, and really all debt markets in general. So let's move over here. So this is Basel III. You can see Basel III is the third Basel Accord, a framework that sets international standards for bank capital adequacy, stress testing, and liquidity requirements. Augmenting and superseding parts of the Basel II standards, it was developed in response to the deficiencies in financial regulations revealed by the financial crisis of 2007 and 2008. It is intended to strengthen bank capital requirements by increasing minimum capital requirements, holding of high-quality liquid assets, and decreasing bank leverage. So the SLR was really an extension of Basel III. People like to call it Basel 3.1 because I guess you can see right down here. They're sometimes referred to as Basel IV. However, the Secretary General of the Basel Committee said in a 2016 speech that he did not believe the changes are substantial enough to warrant that title, and the Basel Committee referred to only 3 Basel Accords. So Basel 3.1, if you hear me refer to not Basel 4, that's what I'm talking about. It's kind of like not QE, but not Basel 4. So I think it's kind of funny, just the way they try to get around what they're actually doing and make it seem like it's not as big of a deal. But there's some pretty big changes that are included in not Basel 3, so I tend to disagree that this is not very substantial. So let's come back over. I want to point out one more thing. This article from Reuters over here. They're saying potentially tighten up the rules on banks to make them more resilient to financial stress. So this is painting this as this guy is going to come in and be a hardball towards these banks and a hardball to the rich. He's looking out for all the people, you know. But what he's doing, I mean, he's adding, his goal is to add exemptions to the supplementary leverage ratio So I don't see how you consider that tightening up the rules on the banks, as it's doing the exact opposite. So just wanted to point that out. This guy is not in here trying to play hardball with the banks. He's in here trying to reduce regulations, and in turn is doing about the exact opposite. So as we've seen over the last several months, the Treasury market has lost its bottom and yields are absolutely through the roof. So we're even at the point where we have a 10-year Treasury that has an inversion with a 6-month Treasury. So that means you're getting paid more yield for loaning to the government for 6 months than you would if you loaned to the government for 10 years. So obviously that doesn't make any sense whatsoever, at least when it comes to the mechanical functioning of the Treasury market. So we can see that there are some pretty major issues that are happening within the Treasury market at the moment, and a lot of the pressure on other markets such as equities and cryptos and a lot of risk assets are due to the increase in yields among debt instruments. And not just the increase in the yield, but the rate of change as what it's happening. You know, if a Treasury yield goes from 1% to 2%, it doesn't sound like a lot, but if it happens overnight, you know, you're pretty much doubling the amount, the interest expense that whoever issues that form of debt is required to pay, as 2% is double 1%. So it may be just a single percentage move, but if you go from 1% to 2%, you're actually doubling your interest payment. And if you do it fast, you know, it's really hard to come up with a lot of money, especially at the tune at which the U.S. government, their problem suggests. You know, their balance sheet is pretty ugly. So a doubling of their interest expense is going to be a problem, and the same concept can be applied to all other debt instruments like high yield bonds. The yield on those has about doubled. So, you know, all these high growth companies that aren't making any money, and you got to consistently go out and find funding. You know, it's going to be a lot harder to refinance your debt going forward. You have emerging market bonds are tanking, yields are going up, same thing. You have the mortgage rate that's going through the roof. That one's at least doubled. So, I mean, most people don't really have variable rate, so it's not a huge problem, but it's really demand destruction within the housing market. So I think we get the picture. The depository institutions' ability to add total leverage exposure and absorb some of these debt instruments onto their balance sheet in a more effective manner actually does play a major role in the economy, especially in today's version of the economy. So now that we have some pretty high headline inflation numbers, the Fed can't really go out and monetize the debt anymore. We're still in a situation where our debt to GDP is a major problem. We actually already have done a video about that. Also, I will link that so you guys can check that out if you haven't seen it. But we're in a situation where we have to get our debt to GDP down, and in doing so, we're causing high inflation. And that's, with midterms coming up, that's something that's not a good look politically for both the Biden administration and Jerome Powell himself, as that whole transitory situation last year kind of blew up, and he's got a pretty bad rep about that at the moment. So I don't think they're going to be as likely to allow inflation to persist in the near future with the elections coming up. So I think they're going to try to find a way to backdoor some monetization of debt, and adding these exemptions to the supplementary leverage ratio would actually be a pretty good way of doing that. So I think that's something that they have on their radar and they're planning on doing. And now that we have Michael Barr taking over as the vice chair of Fed Supervision, I think we're just getting closer and closer to the time that actually happens. So I think we're actually at a pretty critical time for them to come in and update the Basel regulations, as things are not looking too good in the economy. Looks like we're heading into a recession. Everyone's 401ks are in the trash by now. Inflation's through the roof. It's just not a good situation depending on how you want to look at it, all angles. It's pretty bad. So there's something that needs to be done, and if we are looking forward, if nothing changes, there's some new adjustments that are going to be coming into effect in January of 2023. And these regulations are part of not Basel IV, and it's the FRTB, which is the Fundamental Review of the Trading Book. And basically what this does is it keeps depository institutions from being able to move assets from their trading book over to their banking book. So trading books, you need more capital requirements behind them to use for collateral, and the banking books, you don't need as much. So I believe it's in the tune of like 6% capital requirement for trading books as opposed to like 1.5-ish for the banking book. So I'm sure I'm a little bit off on that, but it's within the general vicinity of those numbers. So it's a pretty big difference. And if you remember, the difference between 1 and 2% when it comes to the yield problem that we were talking about earlier is actually a pretty big deal. So 4.5% doesn't sound like too big of a deal for capital requirement increases, but it actually is quite a bit. So we'll get into that. So let's come over here and take a look at not Basel IV. So it's Basel III, finalizing post-crisis reforms instead of Basel IV. So when you see this, or Basel 3.1, it's really not Basel IV. So I just want to come down here and the capital impact. So just to put things into perspective, the December 2020 assessment by the European Banking Authority, the EBA, of the capital impact of implementing Basel 3.1, or not Basel IV, in the EU is an increase of 18.5% in minimum required capital, with the impact for some national banking sector forecast to be much higher. So this is actually a pretty recent report, and they think it's going to increase the minimum required capital by quite a bit, being almost 20%. So if we don't get the SLR exemptions taken care of, this is going to be accelerating the problems that we already talked about. And I would see this as being something that really makes the yields in these debt markets go up even more, as a lot of these depository institutions actually have to unload even more of these assets into a market that already has a pretty large supply and demand mismatch. So I think they're working pretty hard behind the scenes to get this figured out. Well, at least when it comes to getting the SLR exemptions back in place so that we can monetize the debt that is coming from fiscal policies and from the United States government. And we can do it without the Fed being in the limelight and having to lie in everyone's face. We can use the back door, use the depository institutions to absorb them into their balance sheet, and things will run more smoothly. But keep in mind that these regulations were actually put into place so that banks had adequate capital and they were stress tested and they met liquidity requirements. So basically it was, like it says, a response to the deficiencies in financial regulation revealed in the financial crisis of 2007 and 2008. So if not having these regulations in place led to something like 2007 and 2008, and we're getting rid of them just to make it easier to monetize our debt, we very well could find ourselves back in a situation, maybe not like 2007, 2008, but in a situation with the equivalent impact of something like 2007, 2008. So this is a big deal to be paying attention to, and I think we're getting pretty close to having someone in charge that's going to come back in and actually make these updates to the rules like we've been talking about. So I guess we'll have to wait and see how this turns out, but this was some pretty big news that just came out, so I thought I would share it with you guys. I will be interested to see how it plays out. So I think we'll end the video there, and everyone have a wonderful rest of your day. Alright everyone, thanks for watching. We hope you all found this content valuable. If you did, like this video to let us know so we can continue to put out similar content. If you have any questions or comments, or if you have any suggestions regarding other topics you're focused on and would like to see us cover, just let us know in the comments below. And subscribe to our channel to become a part of the most comprehensive upcoming communities on all of YouTube. This economic environment only comes around once in a lifetime, and we're here to act like it. We're not here to talk you up. We're going to leave our emotions at the door and navigate these markets through the good and the bad. Keep in mind that this is not financial advice. This is more of a mastermind that we can all come together as a community and use each other's unique perspectives to better achieve logical conclusions. We really appreciate all of our team out there watching, and we look forward to continuing conquering these markets with y'all going forward. Until next time, stay one move ahead. Have a great day, everyone.